Derivatives and hedging are where most MBA finance students lose marks. If futures, options, and swaps confuse you, this video is exactly what you need. I'll cover the most important Unit 3 questions and give you a free PDF for revision. Let's start. Unit 3. Derivatives and hedging. 1. Explain the concept, types, and features of derivatives. Derivatives are financial contracts whose value is derived from an underlying asset like stocks, bonds, commodities, or currencies. Types are forwards, which are customized OTC contracts, futures, which are standardized exchange-traded contracts, options giving the right but not obligation to buy or sell, swaps, which exchange cash flows between parties. Key features include risk management, price discovery, leverage, liquidity, zero-sum nature, and fixed expiry date. Here's something important for your exam. Many students remember the types of derivatives but forget to write their features. Writing both can help you secure full marks. Now let's look at how derivatives are actually used to manage risk. 2. Explain the various hedging strategies. Hedging reduces risk of adverse price movements using offsetting positions. Strategies include forward contract hedge to lock future exchange rates, futures hedge using exchange-traded contracts for short or long hedge, options hedge using protective puts or covered calls for downside protection, money market hedge using borrowing and lending without derivatives, cross hedge using related asset derivatives when direct instrument is unavailable, natural hedge through operational structure, swap hedge to convert floating to fixed rate exposure. Notice how several hedging strategies use derivative instruments. Understanding this connection makes the entire unit much easier. The next question focuses on two contracts that are almost guaranteed to appear in exams. 3. Define forward contract and futures contract. Explain advantages and limitations. Forward contract is a customized OTC agreement to buy or sell an asset at a future date at a pre-agreed price. Advantages include customization, perfect hedge, no upfront cost, and confidentiality. Limitations include high counterparty risk, illiquidity, and poor price transparency. Futures contract is a standardized exchange-traded agreement with clearing corporation guarantee. Advantages include no counterparty risk, high liquidity, and price transparency. Limitations include lack of customization, basis risk, and margin requirements. Exam tip: if a question asks for advantages and limitations, don't stop after defining the contracts. Those extra points often make the difference between average and high scores. Now let's finish with one of the most frequently repeated comparison questions. 4. Explain the difference between forward contract and futures contract. Key differences: trading venue. Forwards are OTC while futures are exchange traded. Terms: forwards are fully customized while futures are standardized. Counterparty risk: high in forwards, negligible in futures due to clearing corporation. Settlement: forwards settle at maturity only while futures have daily mark-to-market. Liquidity: forwards are illiquid, while futures are highly liquid. Margin: forwards require no compulsory margin, while futures require initial and maintenance margin. Forwards suit exact hedging needs, while futures suit standardized risk management. And that completes Unit 3 clearly. If you can confidently explain the differences between forwards and futures without looking at your notes, you're already well prepared for a common exam question. Grab your free PDF from the description and revise these answers once before your exam. Don't forget to subscribe because Unit 4 covers more scoring topics that can significantly boost your financial risk management marks. Let's continue learning.